Hey, it's Dean Barber, founder and CEO of Barber Financial Group. Welcome to the monthly economic update. It's a doozy. Lots of records being broken and things that we've never seen before. Bud Casper's going to join me here. And while we're doing our social distancing, give you as much information as we can about what we're seeing, what we're doing, what we're hearing, and what we think is ahead. Enjoy. Thanks for taking a few minutes to join Bud Casper and myself for this month's monthly economic update. As everyone knows, we're on lockdown, and so Bud and I are attempting to do this virtually. And we've got our good engineer doing the recording and setting it all up, but we're going to give some data here. So Bud, thanks for taking a few minutes to share your thoughts on the economy and this economic update with me. Let's start with what I'm showing here on the screen. And what I've got up here is the 12 different sectors of the markets and a chart of those on a year-to-date basis. And, you know, if I start adding in energy, it's really technology, industrials, materials, real estate, virtually there has not been a safe haven in any sector in this bear market. And this thing came at us at lightning speed, the fastest decline from 30% ever, even greater than the speed of the decline in the Great Depression. And Bud, just as you and I are doing this recording, we're doing this on the 25th, negative interest rates appeared in the United States for the first time ever on the 1 and the 3 month Treasury. Now, negative interest rates have been a reality around the globe for several years, but never in my wildest dreams, and I don't think yours ever either, Bud, did we ever think we would see negative interest rates on our Treasury bills here in the United States.
No, you're exactly right. And the Federal Reserve had backed up our thoughts, by the way, because earlier and last year, when the negative interest rates in Europe were becoming more pronounced, they were saying, no, we don't see negative interest rates ever coming to the United States. And yet here it is today. And now we have negative interest rates on the, 1 month and 3 month, I believe.
Yes. And so, Bud, what is that telling us? Is this telling us that people are willing to get paid less than what they put into these treasuries just for the safety of knowing that they've got the full faith and credit of the United States government behind it, so that they're that fearful of everything else out there that they're willing to accept a small loss on their money just to know that they're going to get at least most of it back?
I think that's what the normal definition is, that I'd rather pay a little bit of money and have it back by the United States government rather than being in any other type of a position that is out there. But at the same token, when we examine exactly what we're seeing with this, remember that this is just another one of what we call a black swan event, something that is totally unpredictable, totally unexplainable, that is happening at the speed of lightning. Remember Superman faster than a speeding bullet? Well, that's exactly what this has felt like, because when the high water mark of the market ended on February 19th, I think it was up somewhere around 4.8% at that time. Put that on top of the approximate 30% gain that we had in the total year of 2019. And within 30 days, giving up all that return that we experienced is unprecedented, Dean.
Well, and before the biggest gain that we've ever seen since 1933 that occurred on Tuesday, you had to go all the way, Bud, back to January of 2017. And so essentially, in a 30-day period, this market wiped out all of the market gains. And I'm speaking on the Dow Jones Industrial Average for all of 2017, all of 2019, and the first couple of months of 2020, all gone in a matter of 30 days. And I think that, obviously, there were some adjustments and some things that we've made in the different portfolios that we have, some more tactical, some more asset allocation driven. Each one of those different types of portfolios that we're managing for you are all there's been attention to those. There's been things that have been done. The important thing here is to understand that, we've never been here in this type of an environment before, where we have a virtual shutdown of the global economy. The impact by some people says it's going to be, it's going to be pretty sharp, but it'll be short, and then we'll see a rapid recovery. So, Bud, you were referencing something as you and I were talking earlier this morning about some quotes from our former Fed chairman, Ben Bernanke.
Yes, Bernanke came out on Wednesday, and he said that he thought that we'd have a sharp recession, but a quick recovery. I think I can get behind that because of the amount of stimulus that is being put in front of this issue that we have at this time. This is like trying to put the genie back in the bottle, though, isn't it, Dean? Because, there's so many negative effects that have occurred because of this. People that have lost their jobs, they've lost their insurance, that it's very hard to reverse those issues. And employers have been faced with decisions that they never wanted to have to deal with before, and most certainly never had any concept that this was going to happen, or they would have to take the type of action. Who would believe that the restaurants entirely around the city that people live in are closed, and that the only way that they can get any type of revenue is to do curbside delivery of food that you might be able to order from them? I mean, this is apocalyptic in the sense that we've never seen this kind of stuff. This happens in third world countries, perhaps, but not in the United States.
Right, and I think that I've seen, we have either a fight, a flight, or a freeze, and that's kind of what people will do. And what I'm seeing is both the flight and a freezing, right? So some people are just, I'm not doing anything. I'm because I don't know what's going to happen, so I'm not going to make any changes. I'm not going to do anything. Well, maybe that could be right. Maybe it could be wrong. There's no crystal ball here. I think the worst thing that a person could do at this point in time is the flight, to just, run scared, because look, we have great companies. We've got a Congress and a president who are committed to putting the entire power of the United States government. We've got the Treasury officials, central banks, all providing liquidity into the bond markets. And, this is something that I think that it's going to last for a while. And I think it's going to take, from a governmental and fiscal perspective, years in order to unwind the stimulus packages and what the treasuries are doing. But the Treasury Department was really forced to come in, and central banks, and say, gosh, we've got to provide liquidity to the bond market, because last week we saw the biggest panic in the bond market that we've seen since 2008. And so what normally would be your safe haven type of investments, those also got taken down last week, not nearly to the degree that stocks have, but still, those are the things that you expect when the markets are doing poorly would do well. But the bond market is acting like, Bud, we're going to have massive defaults and massive bankruptcies, and the real estate market is acting the same way on the traded REITs. And so, that's, I think, the part that's spooking everybody. But markets have a tendency to overreact. They have a tendency to overreact to the downside and to the upside.
And that's why, in Trump's plan, they are providing $2 trillion, I think a little bit more than that, Dean, for them to keep the window open for Fed borrowing, so that there is a backstop to this, which is necessary. If you want to think about this in comparison, because right now what I want to do is to go to the happiest place on earth, which of course is Disney World. Oh, it's closed. I guess we won't be going to the happiest place. So we'll just stay in our houses and shelter in, right? But if I was going to get at, was back in February of 2008, President George W. Bush signed into law the Economic Stimulus Act. Now, that was a black swan event, which we really haven't gone into the details of that, Dean, quite yet. But my point is, we had legislation that provided taxpayers rebates from $600 to $1,200, which was put there to encourage citizens to spend, to reduce taxes, to increase loans on homes from Fannie and Freddie. The so-called stimulus package also provided businesses with financial incentives, just like we're talking about right now, because of available capital for them to be able to borrow inexpensively from the government in this particular case. Dean, you and I remember vividly in 2008, if my memory was right, I think it was somewhere around September of that year, that Congress came up with what was called TARP, T-A-R-P, Troubled Asset Relief Program. It was a $700 billion package to do what? To loan to the banks with interest to be able to recapitalize these banks, which they should have been in the first place, but were not because we didn't regulate them enough. But how did that turn out? Did taxpayers just cough up more money that the government saw fit to give away to the banking system? No, the reality is all that money was paid back to U.S. taxpayers with interest, I might as well. I think this allows us to see a blueprint from '08, and we can take part of that blueprint into what we have now, even though we have offshoots of this that are quite different. But there is the fundamental rebuilding, if you will, Dean, of the foundation to get solid so we can then expand from here.
Yeah, Bud, you're right on, and nobody's got a crystal ball. We don't know exactly how this whole thing's going to unwind, but I think that what you're talking about is the very reason why we saw such a surge in the market on Tuesday, with the hopes of this new stimulus package being passed. And as word got around that it's closer, okay, we're getting there, then there's going to be some relief. But look, I think that we would both be remiss, Bud, if we were to assume that the volatility is behind us, and just because Congress passes a stimulus package that there's not going to be any more volatility, there's not going to be any more uncertainty, because we're in the early stages of this, and I think there will be more volatility. I think there will be more uncertainty, and I think the thing that we got to impart out here to our clients and people that are not yet clients but maybe want to become clients is that in our financial planning process, we can identify what I'll call the Goldilocks portfolio. What's the right thing for you, right? And if you're having trouble sleeping, if there's a little bit too much uncertainty, you need to speak with us. You need to let us know what you're feeling, what you're thinking. We can make some small adjustments. What we don't want to do is make wholesale changes and get caught on the wrong side of this super volatile time, Bud.
I agree with that. Going back to the '08 timeframe, since we have somewhat of a blueprint of what happened at that particular point in time, and just to put people's minds at ease that this time at this present day, some things have vastly improved over what they were in 2008. The point I'm making is that everybody remembers that Bear Stearns went out of business, a venerable 100-plus-year-old company at that time. Lehman Brothers, the largest bankruptcy we had in U.S. history, happened at that time, as they went out of business. And then $85 billion was provided as a line of credit to AIG, who was deemed to be too big to fail.
Right.
Well, I'm telling you that isn't the case today, because what came out of that was Dodd-Frank, which was a congressional act that came up that forced the banks to do what Glass-Steagall did back after the Great Recession, and that is you got to have certain amount of capital in your bank at all time to be a bank. And
Right.
They forced that, and they regulated it, and they tested it and tested it. And our banking system is more solid today than it's ever been. And so I don't have those particular types of issues. And I want people to put that aside, because that isn't where we are at present time.
Right. I think what we have to do, Bud, is, we make sure that we're keeping an eye on every single thing, every single day, staying on top of this, and have some faith in the fact that, the Great Recession is not too far in a distant memory. And there were a lot of lessons that were learned from that. And I think that a lot of the lessons that were learned from that have caused some very quick and swift action. We already know that the Fed is stepping in and doing more today than they ever did during the Great Recession. And so I have some comfort of thinking that, we're going to get through this, and the shutdown of the economy will be a short-lived shutdown of the economy. And with the support of the government and the feds, that we won't have massive bankruptcies. We won't have to have massive layoffs, and we can come out of this on the other side looking great. Only time's really going to tell, Bud, but we got to wrap this up. Thanks for taking time to share. Anything else you want to share before we go?
No, I don't think so, Dean. Let's face it, America is at its best when it's in troubled times. People pull together. And even though we have a very split party system here in the United States presently, I think that too will mend itself somewhat so that we can get on the same page and find ourselves out of this problem and back into prosperity, perhaps just a couple of months from now.
Awesome, Bud. Thanks for taking some time. Ladies and gentlemen, thank you for taking time to join us for our monthly economic update. I'm Dean Barber along with Bud Casper. Look for us again in a month. For all of our viewers on YouTube, thanks for joining us. Make sure and give us a thumbs up, hit the bell icon, and subscribe.